This is an absolute disaster. Hey guys, Britt here. Welcome to End Times Bible Prophecy. What am I talking about? Well, I'm talking about the ongoing commercial real estate crisis and its impact on the U.S. banking system and by default, the entire global financial system. Now, I've had a number of people in the past couple of weeks ask for an update on this topic. Where do things stand now? How have things progressed, I guess you could say, in the past quarter or two? And guys, unfortunately, it's gotten worse. So today we're going to talk about exactly what's happening in the commercial real estate space, how it impacts the banking system, most important, how it impacts End Times Bible Prophecy, because I believe it directly does. But first, just a reminder, I want to take a look at this. This is from brittgillette.substack.com. This is an article that went out yesterday. If you're not signed up to the Substack, you probably missed this, but you're going to want to go check this out. It's titled, "Are We Witnessing the Great Falling Away? Why We Have Every Reason to Believe the Tribulation is Near." And this is referencing the passage from 2 Thessalonians chapter 2, verse 3, as well as, what does that mean? What is it talking about? And then what are we seeing, such as celebrations of drag in churches and pastors calling for Jesus to no longer be called Savior? So again, go ahead and check that out. If you haven't already, I'll pin a link at the top of the comments to that article. So now back to what are we talking about? What's going on with commercial real estate? Well, let's start right here with this. This is from Narada Real Estate Investments from back in January. It says commercial real estate crash could trigger an economic tsunami. It says for decades, commercial real estate has been the bedrock of the American economy, a steady, reliable giant. But now cracks are appearing in this foundation. A chorus of financial experts is sounding alarms, warning of an impending crisis that could reverberate far beyond the property market. With over $1 trillion in commercial real estate loans maturing in the next 2 years, the perfect storm is brewing, Harvard Business Review reports. Rising interest rates coupled with plummeting property values have created a treacherous landscape for investors and lenders alike, and the implications of the broader economy are profound. Is this the beginning of a domino effect that could topple even the most stable financial institutions? The evidence is mounting. The alarm bells in commercial real estate market echo louder as it grapples with a unique trifecta of challenges. These include the aftermath of the COVID pandemic, rising operational costs, and deteriorating property valuations. A key revelation highlighted by Harvard Business Review is a distinct pattern of overexposure of U.S. commercial banks to the commercial real estate sector, particularly among community and regional banks, which have become increasingly vulnerable to market fluctuations. And we've talked about this. This isn't concentrated in the larger banks. This is more in the mid-size and regional banks. But it's a problem across the banking sector, as we'll look at as we go through this. It says, according to an analysis from the Conference Board, a staggering more than $1 trillion in commercial real estate loans will be due over the next 2 years, significantly impacting small and mid-sized banks. And I would say it's well over that. It's almost $1 trillion just this year alone. Many of these financial institutions lack sufficient capital cushions, placing them at heightened risk for considerable losses. As the Federal Reserve maintains elevated interest rates, property valuations are expected to decline, creating a perfect storm for banks to face delinquencies and default risk. So what precipitated this precarious situation? The roots can be traced back to several significant economic shifts post-pandemic. The pandemic fundamentally altered work patterns, resulting in an accelerated move toward remote and hybrid working models. And I would say even after a lot of that has ended for some businesses, in a lot of cities, people just moved. They moved from the Northeast, from California to places like Texas and Florida and Tennessee. And so you don't see the problems necessarily in those markets that you see in some of the other markets from where people move from. The workers just aren't there to go back into the office. They just aren't. It says leading to increased office space vacancies. Heightened operational costs, largely driven by surging insurance premiums, labor shortages, and energy prices, further stoke the crisis. An aging population seeking more skilled labor compounds the issue, forcing companies to increase wages. This economic strain is particularly acute in sectors most reliant on physical property, such as retail and office spaces. The ripple effects of rising operational costs and falling property values are evident in the alarming increase in delinquency rates on commercial real estate loans. Over the last 6 quarters, the percentage of non-performing commercial real estate loans doubled, climbing from 0.54% to 1.25%. This statistic showcases a concerning trend that mirrors previous financial downturns, specifically the lead up to the 2008 Great Financial Crisis, when loan delinquencies significantly increased. And if you look at this chart, this is nowhere near the all-time highs. The all-time highs during the Great Financial Crisis were 8.75%, I believe in 2010 in the second quarter. So we're nowhere near that, but as we read through this, we'll find out why. It's because they've been doing something called extend and pretend and holding these back. But as we'll look at, this is actually already worse than the Great Financial Crisis. And it's just a matter of when does all of this hit the bank balance sheets? It's going to be awful when it does. So this says one of the most unsettling aspects is the disproportionate exposure smaller banks have to commercial real estate loans. Data showed that small banks with assets between $100 million and $1 billion have commercial real estate loan values exceeding 158% of their risk-based capital, while mid-sized banks are even more exposed with a ratio of 228%. And this is on average. We've talked before, and we'll look again at the Florida Atlantic University surveys, which show that bank regulators look at 300% as overexposed and putting a bank at greater risk of failure. So here we have mid-sized banks on average at 228%. It says in stark contrast, large banks with assets over $10 billion exhibit significantly lower ratios of 142%, and the largest banks are at 56%. So the larger the banks get, the less exposed they are to the sector. But the banking system as a whole is facing a lot of problems, and there are hundreds of banks facing significant problems, as we'll look at. It says this disparity indicates that while larger institutions have more robust capital buffers and regulatory requirements, smaller banks may resort to, quote, extend and pretend strategies. That's exactly what they're doing. And we'll look at more of that as we go through this video. It says delaying the recognition of losses in hopes of a market recovery. Such approaches may be dangerously misguided and could exacerbate economic instability. So let me tell you, hope as a business plan doesn't work out too well. Now, hope in the Lord, hope in the Word of God, that's good. That's a good thing. But when you're a bank and you're looking at all these massive losses and you say, I'm just going to brush this under the rug, not look at it, I'm going to look away. For those that used to watch the show Sanford and Son, Fred Sanford, he'd get these bills and he'd put them back in the mailbox, right? He just wouldn't look at them. But that doesn't make them go away. And so that's what we're looking at here, is they're ignoring them for now, but eventually they can no longer ignore these. So it says, what could push the commercial real estate sector over the edge? Several factors loom on the horizon. It says, should multiple community and regional banks attempt to raise equity capital concurrently, it could lead to instabilities in the banking system, akin to the panic we witnessed in March 2023, when only a few banks faced severe pressure back then. 2, the repercussions of the current volatile economic environment could trigger greater demand for credit risk compensation, increasing yield requirement for investors. In other words, the rates could go up. A new recession, number 3, a new recession could accelerate concerns in an already precarious market, creating a domino effect, leading to widespread asset devaluation, meaning a fire sale of these commercial properties. We've already seen signs that we're entering that again. The Atlanta Fed saying GDP is contracting this quarter. So we have, should these triggers materialize, the fallout could be catastrophic, with potential losses rippling through the financial system. If commercial real estate loans experience a 10% loss, it would leave more than 100 small and mid-sized banks undercapitalized. A 20% loss could push over 900 banks, including some larger institutions, into a similar predicament. Guys, I think it's going to be beyond that 20% loss. So how about this? We've got this from the Daily Economy. This is from back in December, but it has a little bit more of info on the state of what's happening. It's titled "The Commercial Mortgage Crisis Deepens." It says the delinquency rate for commercial mortgage-backed securities tied to office properties reached 10.4% in November, approaching the 10.7% peak reached during the 2008 financial crisis. The ascent is the fastest 2-year increase on record, with rates climbing 8.8 percentage points since late 2022, significantly outrunning the 6.3-point rise seen during the financial crisis nearly 15 years ago. So again, this rise in delinquency for the commercial mortgage-backed securities is the fastest on record, worse than the great financial crisis. Guys, this is telling us the truth about the state of this market. So back in the last article we just looked at, they said, well, rates have doubled for delinquency on these properties, default on these properties, to a little over 1%. And the worst of that during the great financial crisis was 8.75. So we're nowhere near that. But they've been doing this extend and pretend, which means we're just going to hope that things get better. We'll don't pay that loan for the next year. You can start paying later if we think things will get better. But in reality, so a lot of these loans, especially at the higher banking limits. So like at the bigger banks, they put these together into commercial mortgage-backed securities, and they sell those out all around the world. But investors recognize the losses that are coming, and so we're seeing them shy away from these. And so that's why we're seeing losses, the delinquency rate on these going up, whereas these extend and pretend loans at the regional banks, that the regional bank is responsible for all of it. It's not tied up and sold off to investors. That one bank is holding all of the potential liability for default on these properties. And so they're extending and pretending, hoping it'll get better. But eventually these same losses are coming. And when they do, it's going to have a massive impact on the global financial system. It says the office real estate sector has been grappling with a severe downturn for several years now, but are accelerating recently as they're driven by persistently high vacancy rates and declining rents. Property values, particularly for older office buildings, have plummeted, with many losing 50 to 70% of their market value, and in some cases becoming effectively worthless. Those conditions have left real estate portfolio managers and building owners unable to borrow, refinance, or sell properties, contributing to rising delinquencies and foreclosures. And so, guys, this is going to hit the banking system hard. We've already looked at the massive unrealized losses on bank balance sheets that isn't even including this, right? That's a totally separate issue from the commercial real estate crisis. But we have this right here from Florida Atlantic University. So this is from back on March 10th. And we've looked at before how they're tracking these issues within the banking system. They say commercial real estate troubles threaten U.S. banks. It says the U.S. banking system is on a precipice as exposures to commercial real estate grow and banks grapple with higher interest rates, according to an analysis by a finance professor at Florida Atlantic University. Of the 158 largest banks, 59, so that would be 37% of the 158 largest banks, are facing exposures to commercial real estate greater than 300% of their total equity capital. It's reported in the fourth quarter of 2024. And we've pointed out that is the threshold at which regulators say that banks are at greater risk of failure. So that's considered alarm bells should be ringing when you're at 300% or more. The banks most at risk are Flagstar Bank, Zion Bancorp, Valley National Bank, Synovus Bank, Umpqua Bank, and Old National Bank, each of which has more than $50 billion in total assets. Quote, regulators have been putting pressure on banks to reduce their exposures. However, it's a very difficult thing to do without sending a signal of weakness to the market and creating more problems, said Rebel Cole, PhD, Lynn Eminent Scholar Chaired Professor of Finance at Florida Atlantic University's College of Business. Quote, to get around this, many banks are extending and pretending by restructuring their loans. The U.S. Bank's exposure to risk from real estate screener, a part of the banking initiative at Florida Atlantic University, measures the risk to exposure from commercial real estate at the 158 largest banks in the country, all with more than $10 billion in total assets. So that's $10 billion each or more, not $10 billion total. It says using publicly available data released quarterly from the Federal Financial Institutions Examination Council, Cole calculates each bank's total commercial real estate exposure as a percentage of the bank's total equity. Bank regulators view any ratio over 300% as excess exposure to commercial real estate, which puts the bank at greater risk of failure. Quote, banks choose to extend these loans, hoping interest rates might drop. While the Fed did cut rates, he said if a loan is maturing from 5 years ago in today's rate environment, rather than refinance it with today's terms, they'll restructure the loan under the same terms from 5 years ago for 1 more year. This all depends on interest rates falling, which is not likely to happen this year. And guys, there's more to this than just the interest rates. If the property value has dropped, oftentimes they need the whoever's getting that loan to put up more cash, because oftentimes what's owed on these buildings exceeds what the building is now worth. And these buildings aren't cash flowing because they have higher vacancy rates than they did 5 years ago. They have higher insurance rates, higher operational cost. And so it doesn't matter if the interest rates go down 5% from where they're at right now. It doesn't magically make these cash flow positive properties at the values under which they were lent. The banks made these loans. So they're not going to, extending and pretending, hoping for lower rates is not going to work out in most cases. It says among banks of any size, 1,788, so almost 1,800 banks, have total commercial real estate exposures greater than 300%. That's up from 1,697 in the third quarter. So from the third quarter to the fourth quarter, we saw an extra 100 banks added, almost 100 banks added to that list. 1,077 have exposures greater than 400%. That's up from the third quarter. 504 have exposure greater than 500%. Again, that's up from the third quarter. And 216 banks have exposures greater than 600%. That too is up from the third quarter. It says for comparison, the aggregate industry total commercial real estate exposure is 132% of the total, unchanged from the third quarter. So what that tells us is that some banks are getting worse at a faster rate than the total industry. That's what that's telling us. So guys, this is going to be bad when this finally hits the major headlines and people become aware of this. And it very likely is going to lead to bank runs, especially at some of these banks that they just mentioned. What was this? Flagstar, Zion, Valley National Bank. Once this becomes public knowledge, people are going to say, why would I keep my account there? And they'll start moving it over. So this is from CRE Daily. This is from just a couple of days ago. It says, distressed commercial real estate loans are squeezing regional banks again. It says, rising commercial real estate delinquencies, a wave of loan maturities, and persistent economic uncertainty are putting regional banks under renewed pressure. 2 years ago, the U.S. witnessed the second, third, and fourth largest commercial bank failures in history, as Silicon Valley Bank, Signature Bank, and First Republic collapsed under a mix of deposit runs and rising interest rates. And guys, we talk about that all the time, but this is the first time I've ever read this in an article that they even mentioned this, that's how big it was. The second, third, and fourth largest. Even if these had occurred during the great financial crisis, accounting for inflation, they still would have been the second, third, and fourth largest bank failures. That was a big deal back in 2023, and the mainstream corporate media acts like it never even happened. According to the Commercial Observer, the government stepped in to stabilize the financial system, but concerns remain about whether another wave of regional bank failures could be on the horizon. The primary driver of risk today? Distressed commercial real estate debt. Rising vacancies, high interest rates, and declining property values have put billions in real estate loans underwater, especially in the struggling office sector. According to the Mortgage Bankers Association, a record $957 billion in commercial real estate debt is set to mature this year. So it's not $1 trillion over 2 years. It's almost $1 trillion just this year alone. Many regional banks heavily exposed to office loans are engaging in extend and pretend strategies, delaying reckoning with losses. Notice that says delaying, not avoiding. They're not avoiding the losses. They're simply delaying the losses. And notice part of this extend and pretend is pretend. Let's pretend everything's fine, right? That only works until it doesn't. Eventually, pretending ends and we have to deal with reality. It says office special servicing rates are now 16.19%, a 25-year high. What does that mean? Well, these special servicing rates, that's an indication that a third party had to come in and help or manage, I guess you could say, a tenant that someone who took out a loan who is no longer able to pay it. They're no longer making those payments. They're delinquent. They're struggling. So this third party is brought in to help manage this process, leading up to eventually probably foreclosure. And so the lower this number is, the better it indicates how healthy that market is. The higher it is, the worse off that part of the industry is, and it's at a 25-year high. It says overall commercial mortgage-backed security special servicing rates jumped from 7.14 in February 2024 to 10.32% this past February. So again, this was overall commercial mortgage-backed securities. This was just for offices. So office space is being hit in particular. It says uninsured bank deposits now make up 40% of all commercial deposits, increasing liquidity risk. What does that mean? Well, that means putting the banks at increased risk of a bank run. Because again, if you're a business, I don't have $250,000 in the bank, right? So that's under the FDIC threshold. So I'm a little less concerned about, will the bank fail, right? Because, well, my deposits are insured. But for a business that has payroll at a bank, they might have $1 million, $5 million, $10 million at the bank. Only $250,000 of that is insured. So if they find out, well, these banks have these commercial real estate losses they're extending and pretending, they might say, well, let me go let's move our account to this other bank that doesn't have those exposures. And that's when you have a run on the bank. Says some expert, that's exactly what happened in 2023 with Silicon Valley Bank, Signature Bank, and First Republic. Says some experts like Chad Carpenter, CEO of Revan Capital, predict, quote, a hard landing recession, let's call that a depression, we're already in it, if banks are forced to recognize their losses. And let's change that if to when. These losses aren't going to go away. It's just a matter of who's gonna eat the losses. Is it going to be taxpayers? Is it going to be the banks? Who's it going to be? But the losses are there. They're unavoidable. So it's a matter of when the banks are forced to recognize their losses. Others argue that regulatory rollbacks under the Trump administration could allow struggling banks to merge, avoiding systemic collapse. So they're basically saying, we have a failed bank, and we'll have a bank that's near failure, hadn't failed yet, acquire the failing bank, and then they'll be stronger, right? That's not how it works. We saw this during the great financial crisis when we saw these bank mergers, and it turned out worse than those banks needed bailouts. There is no easy way out of this crisis. And so, guys, if we go over to X, Kristen Shaughnessy has an account where she has looked at a number of these commercial real estate stories and what's going on. So I'm going to run through some of these real quick to show you exactly what's happening here. So she talks about, well, this office building headed into foreclosure in San Francisco. Well, they owe more on it than it's worth. So the total owed on it is $24.7 million. But, well, the appraisal says it's worth $16.3. So that's going to end up being a loss for the bank. How about this? So we have an $84 million loan default in Atlanta. We have another Atlanta office building where the lender gets it for a 27% discount. They call it, you got a bargain. You got a 27% discount. No, to avoid foreclosure, what happened was the developer that owned this building that took out the loan with the bank simply walked away and said, you know what? This isn't cash flowing for me anymore. Here's the keys. It belongs to you now, right? So it was returned to the lender at a discount. Well, it was returned to the lender valued at 27% less than what they lent on it for. So that's called a loss. They try to make it sound in this article like they got a bargain. They got a sale. No. They already paid for it, right? They already paid for it, and now they're getting stuck with it. They were hoping somebody else would pay off the loan. They are not. How about this? We've got a $350 million loan default on a San Francisco office tower. Or we have this, a foreclosed market center in lower downtown acquired at auction, was snapped up for less than what had been owed on the property. Here we have a Boston skyscrapers being auctioned. No Boston office building anywhere close to this big has sold or gone through a foreclosure auction, according to Boston Business Journal. This is from last month, a few days ago, this was actually sold. It sold for $400 million. Hey, that's great. It sold for $400 million. The only problem, 2 years ago, it sold for $1 billion. So that's a 60% loss in 2 years. Somebody is eating a $600 million loss, most likely the bank that made that initial loan. Guys, this has been going on for a while. We looked at this back in August. This is 135 West 50th Street in New York City. 2006, this building sold for $332 million. Yesterday, again back in, so that would have been July 31st, it sold for $8.5 million at auction. That's a massive loss when you do the math. And that's a massive loss for the bank that lent on it. So where's all this headed, guys? This is headed for a massive banking crisis. We've talked before about all the $500 billion in unrealized losses on bank bond portfolios alone in the US. That doesn't even include what we're looking at today. And it doesn't include when people start losing jobs as a result of an economic downturn and then start defaulting on credit cards, auto loans, mortgages. The banking system is it's an absolute disaster right now. Of course, they're going to tell you, oh, everything's fine. They'll tell you that right up until the moment when they can no longer say that. And again, for those of you that have been watching this channel for some time, you know we've looked at, back in 2022, the FDIC had this sort of war game where they talked about a systemic resolution to a big bank failure, a failure of a big financial institution that's systemically important to the financial system. And they said, well, we need to be transparent. And they had their list of who they're going to be transparent to and when they're going to be transparent to them. And when it comes to you and me and the public, there's no transparency, guys. They even laughed about it and said, well, you and I and the people in this room, we don't have any faith in the banking system. But the general public, well, we need to make sure that they do. Because that would be a disaster if all of a sudden they lost faith in the banking system. And it would, because it would mean bank runs on banks that since March 2020 are required to have 0% in reserve requirements. So if there's a run on the banking system, the cash is not there. And guys, how does all this relate to Bible prophecy? Well, again, I wrote this article last August, how the current global financial crisis leads to biblical tyranny in 10 steps. We've been in a crisis since then. It hasn't been in the headlines every day. But again, back in the great financial crisis, really wasn't in the headlines every day until the fall of 2008. But if you were paying attention, it was in the headlines for 2-3 years before it became a crisis and millions of people lost their jobs, and we had the worst phases of that. So in this article, we talk about what's likely to happen next, and that's going to include limited bank runs, and it's going to include a bank bail-in at some point. What is a bank bail-in? Well, that's when everybody got upset during the great financial crisis. Taxpayers shouldn't have to bail out banks for making these bad decisions. And they said, okay, you're right. So no more bank bailouts from taxpayers. So how do we resolve the crisis? Oh, we'll bail in the banks. We'll bail out the banks using the depositors' funds, those who had deposits at the bank. So anybody above that FDIC limit of $250,000 gets stuck with an IOU or a ownership interest in a now failed bank. So essentially it's worthless. A worthless piece of paper, a claim ticket on that bank. Everything above that, they lose. They're going to do one bank bail-in at some point. They're going to say, well, because they circumvented this law, which is part of Dodd-Frank, passed after the great financial crisis, when we had the second, third, and fourth largest bank failures in U.S. history 2 years ago. because they knew it would create a global financial catastrophe, a run on banks all over the globe. So they said, well, all deposits are guaranteed. But the senator from Oklahoma, Senator Langford, asked the Treasury Secretary at the time, well, if there's a small bank, regional bank in Oklahoma, would you give it the same treatment? And she said, we'll get together with the president. We'll determine if this is a systemic problem. If it is, then we will. If not, nope, it'll be bailed in. So imagine when they allow a bank, finally, it'll be like Lehman Brothers, because that's what happened in the great financial crisis. Lehman Brothers led to this huge catastrophe in the financial system when they finally allowed something to fail rather than bailing it out. Once they do a bank bail-in, they'll quickly reverse themselves because it will cause a run on banks. As every business runs and gets there, everybody that has more than $250,000 in a bank that is under any idea that they would fail is going to go take it out and put it with the big, too important to fail banks like JP Morgan. They're just going to go do that. And so it's going to cause a run on the banking system and the whole thing. We're going to see stuff blow up all over the financial system. And that's when we end up with the bank holiday we've been talking about, where they shut everything down. I don't know how long that'll be. Will it be a few days? Will it be 3 weeks? I don't know. But the whole banking system's going to freeze. The credit markets will freeze. That means you need to be prepared. You need to have a deep pantry, because all the grocery stores, all the restaurants are going to run out of food within probably 24, 48 hours of that. There will be no trucks to replenish those until the banking system opens back up, and we don't know how long that will be. So you need to be prepared for that moment. Make sure that you are resilient. And then, of course, they'll roll out this new system. And that new system, they've been telling us what it is. It's central bank digital currencies, tokenized assets, digital IDs. Guys, I keep banging this drum because this is what's coming. You need to be prepared for it. You need to be telling the people around you all about it, because we can spread the gospel through this. Because, guys, this is going to set up and establish a system indistinguishable from the mark of the beast system we read about in the book of Revelation. It will be indistinguishable in capability and function, and it will set the stage for the mark of the beast system to roll out during the tribulation. They're putting it in place right now. They need a crisis to roll it out. That crisis is on its way. Make sure that you're planting seeds right now of the gospel with as many people as you can, your friends, your neighbors, your relatives. Tell them about this. They may dismiss it today and say, oh, you're full of it. None of this is going to happen. But when they see these things happen, they'll start to recall, you said this was going to happen, and you said you knew that the system, this new financial system, was coming because the Bible foretold it. How did the Bible know that? What else can the Bible reveal to me? Maybe the Bible is correct when it foretold the life, the death, the resurrection of a Messiah, and all those prophecies were fulfilled by one man, Jesus of Nazareth. So guys, this is very important that we share the gospel, we share the good news, share the hope that we have with the others when it comes to our hope in Jesus Christ. We need to be talking about these events too with other people, because when you do that, you're planting seeds, and those seeds will bear fruit. As people see these events happen and they remember, oh, my friend told me about that. My neighbor told me about that. It turns out they were right. What else are they right about? So guys, plant seeds as much as you can with whatever time we have left. So what do you think? Leave your comments below. Again, I'll put a link to this article as well as the first article that we mentioned. Pin those at the top of the comments. You can go check those out. Let me know what you think in the comments, and God willing, I will see you on Friday.